This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. A lot of times, stepping off the curb and actually starting the process is the most difficult, and that's why Patrick Leonard is here every week on the Wealth Roundup. For wealth management and to start your investment journey, you can find Patrick's contact info at www.patrickmleonard.com. This is the Wealth Roundup for the week of July 24th. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns, just ahead of a couple of weeks of sabbatical for summer. We take a look at the markets and how they're doing here as we get close to the end of July, Patrick.
Yeah, the markets have been somewhat range-bound since about the beginning of June from an index perspective. If we kind of think how the markets have kind of started off today and looking at the last week, is that both Canadian market and U.S. market are up almost 1% today, but they're still actually down from last week. Gold, which had seen a little bit of recovery, some positive momentum, has kind of settled back and is just kind of holding that $4,000 US an ounce level. Oil prices, we're not surprised, back up again. So trading WTI around 85, Western Canadian Select at around 70. So that differential, which we've been watching, over the last, say, 6 weeks, kind of widened again. And then maybe the surprising one is Bitcoin. I'm never exactly sure. I don't think anybody ever is about what catalyst either drives it up or down. This year I was seeing a lot of kind of correlation with the NASDAQ in crypto prices, but that is disconnected over the last month and a half. So perhaps it was last week's lower inflation reading out of the U.S. So that was unexpected that the price increase, the CPI cost in the U.S. was lower than we expected. So perhaps, the market is reading in that maybe the U.S. won't have to raise interest rates by the end of the year. And there is definitely an inverse correlation between crypto prices and the cost of borrowing, because there are a lot of market participants in crypto that use borrowed money to invest in crypto. And, I think maybe the other item that we should pick up, because it's just, popped up since the weekend. So clearly Trump didn't have a great time at the World Cup because he came out with some more tariffs for Canada. So I don't know, maybe Carney, maybe they didn't get along so well up in the skybox. So perhaps more tariffs. We got 30 days here to see whether or not they're actually going to follow through. But it appears that the industries, the Canadian export industries most hard hit here are going to be chemicals, plastics, electronics, industrial equipment, forestry and wood products, some agricultural products, kind of a mixed bag. About $20 billion USD worth of Canadian exports are targeted here. So about 5% of all the goods that we export to the United States would be impacted by these higher tariffs. And if implemented, would bring kind of that pre-tariff level of new tariffs, which was increased by about 5 percentage points up to now about 7.5%. So certainly something to continue to watch, but, we have seen in the past these things might get rolled back as well. But, some news for this week for sure.
So much uncertainty. I mean, every time we turn around, we see prices fluctuating, most times going up. Last week, I went to a meeting from, my home north of Edmonton to a meeting in South Edmonton. And when I left St. Albert, gas was $1.49. When I came back, it was $1.72 per liter. I mean, there's no predicting, and it doesn't matter if it's gasoline or apples or coffee. I mean, everything's getting more and more expensive. How are we in a situation? How can we protect our purchasing power when we're talking about investment, especially for someone who's about to retire or already retired?
Yeah, yeah, it's a great question. So we look at kind of the three major asset classes. We'd say cash, fixed income, and equities. It's definitely cash and holding too much cash, which is probably the most dangerous asset to hold too much of when we have concerns about inflation. Now, we often hold too much cash because there's a reason. We've got a big expense coming up, or we like to have a certain amount of emergency funds. But this is often where we see the most collateral damage occurring due to inflation, because we see that our cash is not going as far as it used to. So your point about gasoline prices is, what it used to cost to fill up your truck with gas, and now what it costs to go and fill it up with gas, right? And we tend to, we measure inflation by the cost of a certain basket of goods and services, and we measure the cost of that basket year over year to go and show us exactly the impact of inflation over time. So it begs the question, what can we do? So yes, only holding as much cash as you have to. Fixed income would also kind of fall into that category, because you tend to have a fixed yield, on, say, a bond or a GIC. And so, yeah, if inflation is running at 3% and your cash is earning you nothing, I suppose you could say that bond or that GIC earning you 3 or 3.5% is certainly helping. But probably what is going to give you the best kind of hedge against that inflation are owning assets that are also going to go up in value as inflation increases. And so, stocks, commodities, precious metals, real estate, infrastructure. These are all assets that tend to go up over time as inflation rises. And so likely those stocks of businesses that have better, let's just say, pricing power with the goods that they sell, meaning their goods are so much in demand that as their expenses go up, so talk about energy prices, which is often for most businesses, it's their biggest cost. Energy and labor are probably the two biggest. And so if their input costs into their business are rising, if they can pass those higher costs onto the consumers of their product, then that becomes a good hedge against inflation. So looking at those businesses, so consumer staples, the things that people have to buy. So you just talked about putting gas in your car. You don't really have an option there, right? And then think about certain things you pick up at the grocery store, the hardware store that you have to get, right? We would call those things consumer staples. So to a lesser degree, consumer discretionary items, things that we want, but maybe things that we don't necessarily need, may not necessarily have that same ability to raise prices as their input costs get higher. And I think the third thing to kind of take into consideration here is that if you have prolongated periods of inflation in your economy, is that your central banks are probably going to want to do something about it. And so what they will tend to do is they will hint that plans to raise interest rates, and so that becomes something that consumers and businesses have to think about, to eventually actually raising interest rates, to perhaps even controlling somewhat, maybe limiting the money supply in an economy. So limiting the money supply that's available to the banks to lend out to people who want to borrow money. So while we would in general say that real estate is also a good hedge, or infrastructure is a good hedge against rising costs, is that those businesses also tend to have a lot of leverage. When people buy a home, they tend to use a mortgage, often use a mortgage. When infrastructure companies do big capital projects, those projects are going to be, in useful life is going to be over 50 years. So they tend to amortize it. They also use some borrowed money. And so if you're using borrowed money as part of a business and interest rates are going up, the cost of that asset is also going higher, and you may not be immediately able to recoup that higher cost. So in general, large businesses, large companies that have shown a track record of being able to pass on higher prices to consumers when their costs are going up are probably going to be your best bet.
And if you're talking about general sort of investment opportunities being affected by inflation and then the possibility of commodities being affected by inflation, how do you invest in commodities if it seems like they're kind of a boom or bust kind of scenario?
Yeah. And being here from Alberta, we know this cycle. We've all lived it. We've all seen the bumper sticker. Just give me one more oil boom and I won't squander it this time, right? Or we love the meme of the garage find with the vintage Porsche and the piece of plywood, and that the lumber was the better investment, right? We
Yeah.
like we understand this, right? And so the thing about commodities is, from an investment perspective, is that you're given kind of two choices. You can either own the raw commodity. So, you can have the extra piece of plywood in the garage or in the shed and, sit on it for 10 or 15 years, right? Or you can, own the business that gets the commodity, either, out of the ground and refines it and then sells it to market. And so those are the kind of choices that you have over time. And then, in general, those businesses, they're going to see their costs go up over time, whether or not it be because of extraction costs, technology costs, labor costs, refining costs, government regulation costs, is that those costs never really tend to go down. Therefore, the underlying price of that asset over time is likely going to go up. So, coming back to this choice of either, owning gold bullion, maybe sticking it in your safety deposit box, or going and owning, a high quality gold mining company, or perhaps owning a exchange traded fund of a collection of gold mining companies, so companies that actually mine for gold, are probably your two best choices. Now, my feeling is that over time, investing in large resource companies, companies that have a long track record of successfully growing their earnings and profitability by going and extracting that raw commodity and getting it to market, is going to give you the best investment outcome, where we measure that success by getting some form of income stream, often in the case of a dividend, and hopefully capital gains on top of that. But those are kind of your choices: is the raw commodity or that equity, that business that's in the commodity business itself. And I think this is really where the stock market and the ability to view a number of great businesses over time kind of allows us to select the winners in that particular group, and make those investments a meaningful part of your portfolio, both to give you those investment returns that you're going to need over your life cycle. And so you talked about retirement. So I'm going to need that through retirement. And so I'm going to get that growth, but I'm also going to have that consideration for protecting against inflation in my portfolio.
And of course, diversity. And of course, going with somebody who has the skill and expertise, such as yourself, to navigate all of those waters, trying to make sure that not everything is in XYZ Gold Company
Yes.
in Inuvik or where.
Yeah.
For wealth management and to start your investment journey, you can find Patrick's contact info at www.patrickmleonard.com. There's the Wealth Roundup for the week of July 24th, 2026. We'll talk to you in August. Thanks, Patrick.
Enjoy your holiday, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.